What is an ISA? Explained for beginners. If you live in the UK and you've ever searched for ways to save or invest money without giving away a chunk of it to the taxman, chances are you've come across the term ISA. But what exactly is an ISA? What does it do? Is it really tax-free? And how do you even open one? Don't worry if all this sounds a little overwhelming. This guide is here to break down everything you need to know about ISAs in simple, everyday language, no financial jargon, just clarity. What does ISA stand for? ISA stands for Individual Savings Account. It's a special type of savings or investment account available to UK residents. The biggest attraction of an ISA is that it allows you to earn interest or investment returns without paying tax on them. That means no income tax on interest and no capital gains tax on investment growth. Sounds pretty good, right? But like most financial tools, there are a few rules and options to be aware of. Let's take it step by step. Why were ISAs introduced? ISAs were introduced by the UK government in 1999 as a way to encourage people to save and invest more. Before ISAs, you had to pay tax on interest earned from most savings accounts. The government realized that many people weren't saving enough, especially for long-term goals like buying a home or retirement. So ISAs were designed to be a tax-efficient way to make saving and investing more attractive. How do ISAs work? At their core, ISAs are just accounts like any other savings or investment account, but with a tax-free wrapper around them. The money you put into an ISA grows tax-free, whether it's earning interest in a cash ISA or rising in value in a stocks and shares ISA. Each tax year, which runs from April 6th to April 5th the following year, you get a new ISA allowance. This is the maximum amount you can deposit into ISAs in total for that year. For the 2024/2025 tax year, the ISA allowance is £20,000. You can divide that £20,000 however you like among different types of ISAs, but you can't exceed the overall limit. Also, the rules say you can only open and pay into one of each type of ISA in a single tax year. What are the different types of ISAs? There are several types of ISAs to choose from, depending on your goals and situation. Here are the main ones. 1. Cash ISA. Think of this like a regular savings account, but better because the interest you earn is tax-free. It's ideal for short-term saving or if you prefer to avoid risk. You can find both easy access cash ISAs, where you can withdraw money anytime, and fixed rate ones, where your money is locked in for a set period in exchange for a higher interest rate. This is a good choice if you want to keep your money safe and accessible, like an emergency fund or saving for a holiday. 2. Stocks and shares ISA. This is where things get a little more exciting and a bit riskier. A stocks and shares ISA lets you invest in things like company shares, bonds, or funds. The money you make from these investments, whether through dividends or growth, is completely tax-free. This type of ISA is suitable for longer-term goals, such as retirement or saving for a house in 5 or 10 years. But remember, investments can go up and down in value, so there's a risk involved. Still, many people have seen much higher returns over time compared to cash savings. 3. Lifetime ISA LISA. A lifetime ISA is designed to help people aged 18 to 39 save either for their first home or for retirement. You can contribute up to £4,000 a year, and the government gives you a 25% bonus on top. That's up to £1,000 of free money every year. However, there are strings attached. You can only use the money, plus bonus, to buy your first home up to £450,000, or after age 60. If you take the money out for any other reason, you'll face a penalty. 4. Innovative Finance ISA IFISA. This one is a bit more niche. An Innovative Finance ISA lets you lend money to other people or businesses through peer-to-peer lending platforms. In return, you earn interest, which is tax-free. These can offer higher returns than cash ISAs, but they carry more risk. If the borrower doesn't repay the loan, you could lose your money. It's definitely something to look into only if you understand the risks and the platform you're using. 5. Junior ISA JISA. If you're a parent or guardian and want to save for your child's future, a junior ISA is a great option. You can save or invest up to £9,000 a year on behalf of a child under 18. The money belongs to the child and they can access it when they turn 18. It's tax-free, and a fantastic way to give them a head start in adult life. Are ISAs really tax-free? Yes, within limits. You don't pay income tax on interest from a cash ISA, and you don't pay capital gains tax or dividend tax on returns from a stocks and shares ISA. That makes ISAs very tax efficient, especially for higher rate taxpayers. But remember, once you take the money out, it loses its tax-free status unless you put it back in during the same tax year and within your allowance. Some ISAs are flexible, meaning they let you withdraw and replace money without affecting your allowance, but not all of them are, so check the terms. Who can open an ISA? To open an ISA, you must be a UK resident, at least 16 years old for a cash ISA, 18 or over for a stocks and shares or innovative finance ISA, between 18 and 39 to open a lifetime ISA. You'll also need a national insurance number and usually some proof of identity. How do you choose the right ISA? Choosing the right ISA depends on your personal goals, your attitude to risk, and your timeline. Ask yourself, am I saving for something short-term or long-term? Am I comfortable with the risk of investing, or do I want guaranteed returns? Do I need access to my money, or can I lock it away for a few years? Am I eligible for a lifetime ISA bonus? If you're just starting out and want to build an emergency fund, a cash ISA might be your best bet. If you're planning far ahead and don't mind some ups and downs, a stocks and shares ISA could be the better long-term strategy. And if you're a young adult dreaming of your first home, a lifetime ISA could give you a serious boost. How do you open an ISA? You can open an ISA through banks, building societies, credit unions, or online investment platforms. These days, it's often as simple as filling out a form online. Once it's open, you can set up regular contributions by direct debit or make one-off payments whenever you like. Before opening one, compare interest rates, investment options, fees, and flexibility. Some providers have better features or better customer service than others, so it's worth shopping around. Can you transfer an ISA? Yes. One of the great things about ISAs is that you can transfer them between providers if you find a better deal. But you need to follow the proper transfer process. Don't just withdraw the money and redeposit it yourself. Doing so could cause you to lose the tax-free status and eat into your current year's allowance. Ask your new provider to handle the transfer for you. Transfers between cash ISAs are usually straightforward. Moving between different types of ISAs, say from cash to stocks and shares, can take a bit longer, but it's still possible. Are there any downsides? While ISAs are incredibly useful, they're not perfect. Here are a few things to be aware of. Low interest rates. Some cash ISAs offer lower rates than regular savings accounts, especially in a low-rate environment. Investment risk. With stocks and shares ISAs, you can lose money if markets perform poorly. Contribution limits. You can't stash away unlimited amounts. The annual allowance caps how much you can benefit from the tax advantages. Penalties for leases. If you withdraw from a lifetime ISA for anything other than a first home or retirement, you'll face a hefty penalty. Final thoughts. ISAs are one of the simplest and most powerful tools available for saving and investing tax-free in the UK. Whether you're just putting away a bit of money each month or planning to grow a significant investment over time, there's likely an ISA that fits your needs. The key is to understand how they work, be clear about your goals, and pick the right type of ISA to match. And remember, the earlier you start, the more time your money has to grow tax-free. So even if you start small, you're still giving your future a head start.